Hello and welcome to the FII View. My guest on the show today is a man who needs no introduction, a veteran market analyst, Bob Dole, former chief equity strategist at BlackRock, and now chief equity strategist at Nuveen Investments, an asset management company that manages over $200 billion in total assets, joins me with his views on the market. Bob, thanks very much for taking out the time and speaking with us.
And thanks for the opportunity.
Well, let's dive straight into the topic of discussion right now, and that's the Fed's comments. What is your interpretation of what came out?
Well, look, I think Ben Bernanke is signaling that at some point in time they won't be buying $85 billion of securities every month. And I think the Fed is saying the economy in the U.S. is beginning to show some signs of self-sustained momentum. And while it's not strong, he'd be the first to say that, they can see a day when they can stop buying so much paper. I think when markets have transitions in monetary policy, it's always a bumpy transition, and that's what we're going through.
So, just talking about the market's response to the comments, there are two camps of opinion. One believes that this is a bit of an overreaction because, they're still going to be monitoring the economy, and they've said that the Fed policy is not predetermined. The other believes that they put a timeline which is making the markets very nervous.
Look, I think you can have it both ways in some sense. That is to say, the Fed at some point will begin to reduce their amount of purchases, and if it goes from 85, just pick a number, to 65, that's still a lot of stimulus and a lot of monetary ease. But markets never like that change, and therefore we could call it an overreaction, but in some sense transitions are always overreactions. When the Fed begins to go the other way and reduce its purchases, the U.S. economy and the global economy will have to be on sufficient footing that we can begin to focus more on earnings growth, whereas of late it's all been about higher valuations and higher PEs.
So what's your outlook on the markets? Do you think that the markets will continue to be in a range for about 6 months till the event when a formal announcement to withdrawal is made, and post that we would perhaps see a readjustment of that range or a move in the positive direction?
In my weekly commentary early this month, I said for the first time in 6 months, my view is markets need a pause. And the main excuse was the Fed, but there are other things as well. China, how fast is it growing? The issues related to the overconfidence that probably existed, the overbought condition in the market, the U.S. economy itself, how fast is it growing. And so my best guess is we'll have a sidewise pattern that's rather wide, that lasts for weeks, maybe a few months. We could probe lower and have to retrace some of our steps before we take the next move up. I don't think by any means is the cyclical bull market over. It's just taking a pause, and pauses are normal, except we haven't had one for a while, so it doesn't feel very normal.
The projections that the Fed laid out, do you qualify them as realistic or optimistic? Because the last projections made in March were a tad bit higher than the consensus on the street on growth, on unemployment, on inflation.
Yeah, I would agree. The Fed's numbers seem a little on the aggressive side. I thought that perhaps in their meeting earlier this week, they might have used the opportunity to bring the growth forecast down. They haven't, as you know, and I think that's rather interesting. Perhaps they see some signs of improvement that most of the consensus doesn't see. Either way, it's still an anemic growth rate. The forces of delevering, which have been with us since this cycle started, are not going away, so we will not get robust growth anytime soon, in my view.
Right. I'd also like to draw your attention to Bill Gross's comments, where he's saying that taking a cyclical view on the economy right now is perhaps not the best strategy. Do you think that laying down a timeline just as yet was required by the Fed, or perhaps they could have waited for a quarter or so to reassess the situation?
I tend to agree. That is to say, I think that putting artificial whether it's numerics in front of you, as the Fed has done with, for example, unemployment, begins to tie your hands for having flexibility. And I think while at the same time the Fed chairman talked a lot about data dependency, and that's where I fall out. Let's watch the data, and that will help figure out what can be done, what should be done, what needs to be done. But they can wait, in my view, and perhaps will.
So then what do you expect in the next policy meet? A more decisive action on withdrawal with details about how much and when?
I think it's going to be tough to get specifics out of the chairman. I guess he came a lot farther than a lot of people thought. I think the language, if you read between the lines, enables him now to say, I prepared you if we want to move in September and begin to reduce. But on the other hand, if the data is not strong enough, he'll wait till December. And so I think we don't know. If you can tell me the data, I can probably answer the question. But that's what they're watching very carefully.
Okay, so then what does that do for the dollar, which has been showing strength of late?
Yeah, I think because there is a pending beginning of the reduction of this, I call it pedal to the metal, full acceleration of monetary policy, going to begin to go the other direction. That has put a bit of a bid in for the dollar, along with the fact that the U.S. economy has done a bit better than most other developed economies. And my guess is that continues. So I think the path of least resistance for the dollar will continue to be to the upside.
And what does that mean for EM currencies, a basket of which against which the dollar is largely traded? Because I remember that in one of your predictions for 2013, you expected EM equities to do better than DM equities. You know, what's the concern there? And, you know, you think the strength in the dollar is reflecting that concern?
Yeah, there's no question but that a forecast that we made that emerging markets will outperform developed ones is very much under the microscope. We need a big rally in the second half in the emerging markets to get there. I think you hinted at it. When you look at the fact that emerging economies have not set the world on fire, the commodity prices, which are pretty important for many emerging economies, have been sluggish. That's the recipe for further sluggishness in those markets. And then you add, as you just pointed out, a reasonably robust dollar. It doesn't argue very favorably for emerging markets. I think they're cheap enough, and the economic expectations for most emerging economies have been brought down far enough that if I didn't own emerging markets, I would be nibbling away, especially on the weakness we're seeing.
Okay, so let me, get some levels out of you. Where do you expect the dollar to be by the end of this year? And also, what's your call on the S&P 500? Where does it go from here?
The dollar's a tough one. I'd be surprised if on a trade-weighted basis we saw even as much as 5% more strength from here at the end of the year. So just a nominal increase if we even get that. For the Standard & Poor's 500, when we got to this 1650 level, having been at 1687, we put out this cautionary note. I think that the downside is limited to 1550. Which is the former 2000 and 2000 area of the high. Whether we go that low, who knows? Of course, you could always probe lower, but that from the very high to low, if we get there, would be a high single-digit correction.
What would be your approach towards emerging market equities? Because like you've pointed out, there has been growth in the U.S., so money has been going back into the U.S. markets, U.S. stocks. There's been rebalancing from the debt markets to the equity markets as well. Where does that leave the whole story on EM equities?
Well, it depends on your time frame, in my view. The long-term view has to be, if the planet's going to grow, we need the emerging market economies to be there, and therefore their markets will participate. So give me the luxury of putting money away for 5 or 10 years, and I'm going to be overweight emerging markets. The intermediate term view is a little bit more difficult. Again, I would be nibbling on weakness. I think there's a good future in those economies and therefore those markets. But if someone chooses to play the emerging market economies through the U.S. multinationals for the moment, I'm not going to fight that inclination either.
So do you feel that over the near term there's going to be more focus on U.S. funds and U.S. stocks investing in emerging markets than EM funds per se?
Yes, I think that's probably the case. I think this modest dollar rise, the U.S. economy doing reasonably well, and that I think continues to attract flows from outside the U.S. to the U.S. and will enable some of the domestic products in the U.S. that have that U.S. focus to do reasonably well.
Are you also seeing outflows from emerging markets or emerging market dedicated funds?
Yes, so most emerging market dedicated funds, or I should say the broad averages, have modest outflows, and I suspect until the emerging market economies grab hold, that'll take some more time before those outflows diminish.
Okay, since we're talking about the outlook on the U.S. markets, again, opinion over there is slightly divided. One camp believes that valuations are expensive, so look at opportunities elsewhere. The other believes that we've seen the liquidity-driven rally so far. Once investment comes in from corporates at the end of this year or perhaps in the first quarter of 2014, then profits would largely be led by revenue growth, and that would take the markets higher from here. What's your opinion?
So my view is that the wonderful run that we've had on valuations improving probably slows down to, if not a halt, because of this concern about what's the Fed going to do next. So the next noticeable move up in equities, whenever we have it, I think does have to come from earnings, and I don't believe profit margins are going to expand a whole lot, so to your point, it has to come from revenues. And that's not today or tomorrow. We're going to start reporting second quarter earnings soon, and I think they'll be on the sloppy side. Comparisons get easier in the second half, so that's right around the corner, but I think that's what it's going to take. That is better revenues and better earnings for the market to move higher in the U.S.
Where does that leave your view on commodities, especially safe haven assets like gold?
I think that commodity prices will continue to be trendless, and if that's wrong, they'll more likely be down than up. I've just described a world that has pretty slow growth, where the dollar has a bit of strength, where the world's financial system, if you will, continues to heal. All of that combined is not a place where commodities are likely to race higher. Gold, I think, is always a special situation, in my view. Absent the breakdown in the financial system, which is what caused gold to go up so much in the last bunch of years, or inflation returning, it's hard for me to see gold doing well at all.
Right, and one of your other predictions as well for 2013, you had expected that cyclical companies would outperform defensives. The trade has largely been with defensives, and it's been a global phenomenon. When do you see investors engaging or allocating capital to cyclicals in a meaningful fashion, or seeing value emerge in the cyclicals depending on the revival in growth?
Late May was the turning point in my view, and it coincided with some hinting that the Fed was examining how long they would keep buying $85 billion a month. So to me, that was the beginning of the rotation away from defensives, which were also chased because of yield, into more cyclical areas. And so, especially in the U.S., the industrial names, technology, have done a lot better than the utility stocks and some of the consumer staples. So I think the rotation has come. It won't be a straight line, but it's to be played.
You're in India right now. What's the view on the Indian market?
Look, I think the Indian economy is doing okay. It could be doing better. I think that recipe is similar for many other emerging markets, and until that growth gets a little bit stronger, it's really hard to see investors globally allocating more money to emerging markets. So I think the sloppiness continues, but as I said earlier, and will repeat, in my view, over the course of the cycle and the course of the decade, for that matter, emerging markets will do better. They've had quite a period now of underperformance. The valuations come in, and that would include India. And so while I don't want to pound the table because there could be more short-term weakness, over the longer term, I want to be there.
Yeah, but do you think India's position among emerging markets would strengthen going forward, given where allocations stand in EM funds right now at an average of about 6 to 7%?
I think that a lot of the question about how India will do relative to other emerging markets will depend on relative growth rates. And some of the Pacific Rim countries, ex-China, ex-India, ex-Japan, to me offer pretty good risk-reward characteristics. They're slower growing than India or China, but have more developed financial systems, and the markets are not all that expensive. So I'd be very careful how I entered emerging markets, but I do believe, back to India, that with some of the changes that are taking place, some of the productivity initiatives here, the education initiatives, the long-term future is pretty bright.
Okay, if I were to zero it down, between just the BRIC cluster, Brazil, Russia, India, and China, how would you rate India?
So in the long run, I put it in the first spot, and probably because the other three are having more problems currently than India, I probably put it in the first spot in the short term as well. The issues in Russia, the politics, the oil prices. Brazil's going through a difficult path at the moment, as is China. And so my preference in emerging markets is generally away from the BRIC countries, but put them out there, and certainly, again, the long-term, India is my choice.
Bob, how would you account for political and macro risks when it comes to your India outlook?
Well, you just gave a list of things that are certainly bothering the Indian stock market and investors that are global that invest in India, whether it's the pace of growth of the economy, the uncertainties about the election, and I'm not going to fight those headwinds and therefore agree in the short run there's probably more pressure. But I come back to the rise in education and productivity, slow but opening borders. These are the things you want to see in an emerging market for it to grow and become a more relevant part of the world scene. And I think India is heading that direction. But you got to hold your breath and be a little bit patient to get there, I'm afraid.
And what about EM currencies then? Because in India, the big talking point right now is the local rupee and the way it's falling against the dollar. Do you think the pressure is more led by the strength in the dollar or the domestic macros?
Given that the dollar is strengthening against many currencies, I think it's more a U.S. dollar strength story than it is anything to do with the rupee's weakness, because there are lots of other currencies that fit that bill, maybe not so much to the degree. So, and it's not so much the U.S. is doing great things, it's the safe haven status that I think has investors interested in the dollar.
Are you concerned about what's happening in China?
I think one has to be concerned about China. First of all, to repeat, it's an emerging market, and emerging means immature and therefore bumpy. So whether it's the migration of the population from the central plains and the farms to the coast, looking for higher wages, the political, economic, and social implications of that, the immaturity of the financial system, the issues with some of the flows that people have pointed out of late, and an economy that we're not sure exactly how fast it's growing. China's got its challenges, although as as somebody who lives in a country that is the U.S. that's growing 2%, whether China is growing 6 or 7, they're pretty big numbers.
Fair enough. What do you also make of the Japan story amidst all that's happening in the globe? Because till 2013, it was really not a market on the radar, but suddenly 2013 seems to have changed the outlook on the region.
Well, as you well know, Japan has new leadership, and of course, when you couple the, I'll call it somewhat creative combination of monetary and fiscal policy, that's created quite a stir in the investment markets, whether it be the equity market, the fixed income market, the currency market. We've only seen limited effect on the real economy, and while I think there'll be some more, Japan has its issues of demographics, a declining population, declining size of the workforce, negative immigration rates. These are tough hurdles. You can interrupt them in the short run, but I don't know how you grow an economy long term with those headwinds.
Well, Bob, in one of your recent comments, you spoke about how a strong economy is not good for the market because the market has become addicted to an easy money policy environment. How then do you think the market would react once we see revival in growth?
Look, I think that markets, when there's the monetary policy change, as I mentioned at the front end, happen, markets get jittery. But if, in fact, the Fed begins to move in the other direction, it will be because there is good news happening in the real economy. And so under your case that the U.S. does do better from an economic standpoint, that eventually is good for earnings, and that's eventually good for the equity market. But it needs to see some of that before it's going to go there.
Well, then, looking into the future, over the next 6 months, give us your top 3 predictions right now. You could either rework the ones you'd given at the start of the year, or perhaps give us fresh predictions. But your top 3 predictions on how the next 6 months will pan out for the markets.
Yeah, we've never done mid-year predictions, but I guess I'd come back to the equity markets and say the first half was the easy half, the second half is tougher, probably everywhere in equity land. If we can consolidate and hold the gains, it's still in many places, most especially the U.S., will have been indeed a very good year. I wish I could have the emerging versus developed prediction back. I think that probably is not going to happen for this calendar year. What we feel good about, on the other hand, is our call for low nominal growth, for a significant pickup in the yield curve, meaning rising interest rates, and for decent U.S. equity market. I think all of those will hold.
Okay, then leave us with your closing thoughts as you see the remainder of this year.
So I think we've entered a choppy phase. There's no question about it, at consolidating big gains in many, especially developed markets. My guess is until there's more clarity around the monetary situation in the U.S. and what the Fed's going to do and when it's going to do it, we're going to have this choppy action. Earnings will be coming out soon, and keep your eye on that. That could cause individual stocks to move one direction or the other, but I think we're more in a trading range, bumpier market with a little more volatility than we enjoyed in the first 5 months of this year, when it was basically, and it felt like, straight up every day.
Well, thanks very much, Bob, for taking out the time and speaking with us on our 4th anniversary. We really appreciate it.
My pleasure, and congratulations on the anniversary.
Thank you very much. Well, with that, we come to the end of this edition of the FII View. Catch you with another special guest next week.